Let's make sure I'm not putting the security controls that we had last week. Yeah, you can chat. Looks like all good. So, how is everyone doing? Is audio okay? Let's confirm that first. Let me also see if anyone pinging me on Meetup. Wait, no message. You guys able to hear me okay? All right, thanks for confirming, Anthony. Cool. So, yeah, this week seems to be a roller coaster week, I would say, from investing perspective. A lot of things happened this week. FOMC, Janet Yellen, and whatnot, and the confusion between the two government entities going against each other. I've never seen that before in my, in recent times, I would say. So, but that was interesting. So we're going to talk about that. It was from a macro perspective, this was a big week. So we had FOMC meeting. We had, the outcome of FOMC, which in terms of Fed rate increase. So we'll talk about that. Also, I think in our previous meeting, there were questions around 401k. So I do want to spend some time, maybe more as a discussion than as a one-way communication. So feel free to pitch in with your ideas on what you guys are doing with your 401k. What are the things that you're employing. So we'll talk about that. And also, I think I'm seeing a concerted effort across agencies around a crackdown on crypto. So we'll spend some time on that. What else happened? Another big one, a short seller report came out, right? And this, again, very well-respected one, Hindenburg research. And looks like Hindenburg is out there for blood. Few weeks ago, they came up with a short seller report on Adani Group, the world's third or fourth wealthiest person. We spent a little bit of time on that one, but this week they also came out against with a short report against Square, or corporate name is Block, right? So we'll spend some time on that. I don't know, that took me by surprise, but yeah, Hindenburg Research is a respected short seller, and they do their homework before they publish these short seller report. So I haven't had a time to go through the whole report. It's a very lengthy one, but maybe I picked up some summary and some rebuttal from others. What else? TikTok. TikTok CEO was grilled. So yeah, I think there are some opportunities for US-based companies from that. Yeah, so a lot of stuff this week. That's what we're gonna talk through today. Anything else you guys have on your mind? Apart from Fed fund rates and yeah, what all I have? Yeah, so 401k, crypto assets, crypto crackdown, Hindenburg short report, and then a little bit of a fun stuff. All right, cool. Okay, so I'll come back to housekeeping later. I see a familiar names. Sometimes when I see new names, I think it's good to go back and remind where the recordings, etc. are. So I'll come back to this later. Maybe we'll come back to this one. later. Let's talk about the macro level. Starting with Fed funds rate. No surprises here. What we've been seeing over the past many quarters is market is kind of setting the tone for what Fed is gonna do. So same thing. We saw the previous rate hike was 50 basis points, and then after the banking crisis, market was pricing in 25 basis points. So market asks and Fed will give. So that's what Fed did, was to give a 25 basis points hike on Wednesday. After the 2 days of FOMC meeting, they come up with 25 basis points of hike, which was already priced in. So that's why we didn't see too much movement on Friday, on Wednesday, or on Thursday. The outlook is still the same. Right now, I think, and again, FOMC is maintaining that the peak rate will be 5.1%, which is actually lower than what they had earlier anticipated. Maybe the banking crisis is scaring the shit out of our Fed, governors. We thought that banking crisis was done, but no, it is not. Right? After US, now the contagion is kind of spreading out to Europe. So we'll talk about that. And on one side, interesting thing is, on one side, we got 0.25, 25 basis point hike. On the other side, the Fed continued to increase its balance sheet. So which is kind of a little dubious measure, right? So these 25 basis point hike impact consumers like you and I, impact households who are already kind of struggling because interest rates are higher, inflation is higher, loans are higher. You go out for mortgage. I don't know what's the mortgage rate right now, 30-year mortgage. Let me just try to pull that out. 30-year fixed rate mortgage, 6.42%. So in the name of bringing down inflation, Fed has been raising these interest rates, which make these things more expensive for us. But on the backside, Fed is also doing so-called quantitative easing, or basically providing more, creating more facilities for banks to take on, temporary loans from Fed. So whatever we have done over the last 1 year in terms of reducing the balance sheet, in terms of doing quantitative tightening, almost now 65% of that has been undone in just 2-3 days, which is now most people, like retail investors, we don't look at these, right? Not the ones you guys look at this because we come and talk about it here. General retail investors don't look at what's Fed doing with their balance sheet. So, and but this is like, hey, you're putting you're still not doing tightening for the banks and the financial institutions, but the tightening is happening only for the common households, which is not good. So the bank balance sheet continue to now go higher. Sad to see that. I thought some part of a time, eventually we will have to reduce the balance sheet, and by increasing these interest rates and by making these loans, etc., expensive, Fed not buying back the mortgage backed securities, etc. But now they're out to bail out these banks, and we'll see. So other chart I saw related to the same stuff is a Fed discount window. A little bit background on that one. So discount window is an ability by Fed through which the banks can go and borrow money from Fed. So that's that discount window is always open for banks to go and, borrow some money from Fed. So the way it happens is banks will provide a collateral to Fed and then borrow cash from them or dollars from them. Most of the time, the collateral will be these government collaterals, treasury security, mortgage-based security, etc. So interesting thing is this, while on front, if you heard Jerome Powell, etc., front, I think all government institutions are coming and say, hey, our US banking system is cool. Don't worry, we got things under control. There is no issue in the US. There is no systemic issue in our banking sector, right? But the actions doesn't seem to be like that. The words say something else, but the actions are different. When you look at what's happening, they opened up. We see the banks borrowing through discount window. Raj is saying, yeah, look here, not there. Exactly. Yep, that's exactly right. On the back side, the borrowing from the discount window, and this happens when the banks are under stress. They'll go to Fed and say, hey, I need some money to tide back, to tide over the crisis. And this borrowing from the discount window, as you can see here, is even higher than what it was during COVID, is even higher when we had, 2008 crisis. So if Janet Yellen and Jerome Powell are saying, no, everything is in control, the banks are solid, don't worry about that, there is no contagion risk. Oh, Silicon Valley Bank was just one case. They had, the different concentration of their depositors. Their business model was a little different. There is no issue in other banks. The action of the banks doesn't show. Banks, this clearly shows that the banks, at least right now, they are struggling. They are going back to Fed and say, guys, we are having a problem. Our depositors are running out. We need money. And then they're borrowing that money from Fed. So as an investor, it's good to know. And how long will this last? I have no idea. I don't think anyone has, but I'm still not convinced that everything is good, that that the banking crisis is contained or it's over. I'm not convinced. So the other one, this one, which is specifically created for this banking crisis, BTFP, which is a bank term funding program. Again, a new liquidity program. I thought Fed has been talking about tightening and reducing balance sheet, but here's a new liquidity program. And in the last 2-3 days, they have already withdrawn $53 billion of securities or of cash from Fed. So right now Fed is holding the underwater treasuries or securities, or $53 billion worth of those securities, and given all the money to banks, $53 billion worth of money to banks. Right? This doesn't looks like that there is no issue in the banking sector. And so let me look at the other one and this one, right? So we talked about Silicon Valley Bank. We talked about about the First Republic Bank, and for the other ones like Schwab, etc., it's like, no, there is nothing wrong in there. But if you look at this chart, which called credit default swap chart, which is basically insurance that you can take out against the default of the bonds by a particular organization. In this case, it's Charles Schwab. Market doesn't think that everything is okay with the Charles Schwab. the the value of insurance or the cost of insuring against the default by Schwab Bank or Charles Schwab has shot up higher. And when will that happen? If the market feels that there is some crisis at Schwab and they may not be able to honor their commitments to the bondholders. So irrespective of the narrative, market is telling us something different. Okay. and this is fun, you know, Jim Cramer always has things at the wrong place. Insider by 50, you know, when on March 14th comes back and say, hey, this is solid. And again, this is some fun. You'll see on Twitter, Jim Cramer tweets and then, you know, inverse Jim Cramer. But this tweet didn't age well, right? Talking about that, hey, this is really solid because it doesn't looks like there is something happening on the Charles Schwab and the market doesn't think that Charles Schwab is right now solid. The cost of insuring against the fault has gone really high. Right? Other one, this is Deutsche Bank, right? So last week we looked at Credit Suisse. Credit Suisse went kind of, no, I wouldn't say went under because it was bailed out by Swiss government, but it's kind of now it's become a part of a UBS, right? So it's completely gone anyway. Thought that was the only bank, but now the bigger one which we are looking at is Deutsche Bank. Now that seems to be in trouble in Europe. Same case here. The CDS, the cost of the insurance against Deutsche Bank, has been shooting up. Okay, and as always, there is another tweet wherein Jim Cramer is seen talking about Deutsche Bank, saying it's very profitable, very solid bank, doesn't need a bailout like Credit Suisse did. Everything is okay with Deutsche Bank. And the day later, we see headlines that now Deutsche Bank is in trouble and, you know, stock dropping around 12%. So QE is back. Exactly. CMBS will totally smash even the biggest bank. I think CMBS is probably the commercial real estate, if I'm not wrong. Yeah, so do you want to talk about that? So the next shoe to drop is going to be the commercial real estate shoe. Right. Let me just finish with Jim Cramer stuff. Again, this goes back to almost 15 years ago in 2008 when I think this is called Mad Mail. Now it's a part of the whole Mad Money show. When someone had asked Jim Cramer about, should I be worried about Bear Stearns in terms of liquidity and get my money out of it? You should watch this video on YouTube. And he's like, no, there is no problem with Bear Stearns. You'll be foolish to take your money out. Bear Stearns is solid. And 6 days later, it collapsed. So again, guys, do your own study. No one knows anything. So most of these channels are marketing channels for getting eyeballs. And I have seen many of these talking heads flipping back on their narrative based on where the market goes. So most of people will follow the pricing anyway. So do your own diligence. And if we still feel everything is okay from a banking perspective, on Friday, there was an urgent meeting with Janet Yellen called for Financial Stability Oversight Council. This wasn't a planned one. This was an urgent meeting to figure out, you know, what's happening with the US banking system. So in any way, they came out after the meeting and said, hey, US banking system remains sound and resilient. And we're going to continue monitor the developments. Right? So I don't know. I mean, they didn't monitor what's happening with SVB. Now that same contagion is spread across, I mean, all the other regional banks have the same issue. What SVB had, may not be at the same scale, but most of those regional banks are sitting and holding those underwater mortgage, not mortgage, the treasury or the bonds, let me put it, the underwater bonds, right? What was the estimate? It was around $600 billion of bonds are already underwater, right? And this BTFP window, which is right now, BTFP, which is around what, $300 billion. If JP Morgan says that it could become as big as $2 trillion, right? Talk about reducing the balance sheet and quantitative tightening, whereas on the other hand, on the other side, Fed has been providing a lot of liquidity to the banks. So I think, again, I don't have a crystal ball, but looking at all this, what's happening with the banking, I'm still not sure that everything is okay. So I'm being cautious. Okay, coming back to the commercial side, Raj, thanks for that, for the link. Yeah, I'm of the same opinion. So right now, the whole commercial real estate sector is under stress. After COVID, not all the employees, the occupancy or all the employees are not returning back to office. It's not 100%. Even whatever, a lot of companies are forcing their employees to come back maybe 2 times a day, 3 times a week, but still the occupancy is very less. So what's happening is most of these big employers, once the lease expires, they're not going to renew the lease. And now all these developers who have developed these office spaces, if their income from the rents starts to go down, they may not have enough money coming in to pay for the those mortgages or the loans that they're taken on building those humongous office spaces. So, and who have provided those loans? These regional banks. So that may be the next shoe to drop, is we might see a lot of regional banks under stress because, developers can't pay back the loans because they can't get the rental income that they had planned for. Again, with all these layoffs happening, the need for the real estate is also going down. So then what will banks do? I mean, banks can't do anything with those office spaces. They'll have to do a fire sale. But who is buying these office? Who is interested in buying those office spaces anyway? I mean, there is the vacancy level or the occupancy level is already high. So that's going to be another a big, I would say, the contagion that we should see flowing through our banking system. And again, that would again take down many of these smaller banks. So I think a lot of these smaller banks are definitely in trouble. And the big ones are becoming bigger. A lot of these deposits are flowing from the smaller banks to the bigger banks. We are really not sure how much these depositors are insured. And the funniest stuff was on Wednesday after the FOMC meeting. Jerome Powell was saying that all the banks, there is no blanket insurance for all the depositors, whereas Janet Yellen was saying something which was completely opposite, right? So there's a lot of a confusion on who is right. I don't know who manages these calendars, but both of them talking at the same time was completely a big fiasco, right? Two important government officials coming and having an interview at the same time and giving completely 2 different messages. screwed up in terms of what market should, what should be the takeaway from market. Whereas one official saying is, we're not gonna take care of every depositor, whereas the other one says, oh, no, I think Fed will backstop all the, or government will backstop all the depositor irrespective of the amount of deposits. So that was a rare moment when two important positions like Fed chair and the Treasury Secretary were giving a completely different message to the market. Raj Kramer, anything he talks about turn to poop. Looks like history does support that. Money from Charles Schwab Bank moved to safe assets, T-bills. Yeah, and again, I don't blame depositors for moving money out into T-bills, but why not? If T-bills is offering you, a 4.5% to 5%, and rather than me taking a risk on Charles Schwab, if I were to take a risk, I'll probably take a risk on US government, right? US Treasury. So either it's Treasury, or what I also heard, I think I do have some charts around, a lot of money is moving into money market funds, which in fact, they go and buy the Treasuries anyway. It's surprisingly, a lot of retail investors are now inquiring about Treasuries, right? So I play every Sunday. I go for, I've started going again. I had to stop it during the COVID. I go for, a game of volleyball with my friends. And now some of those friends inquired about Treasury, how we can buy US Treasuries. So last Sunday, I kind of took 15-minute session with one of my friends. He directly wanted to buy Treasuries because he's like, my money is sitting in high yield savings account, and I heard that Treasuries are giving some, much better return. So how do you buy Treasuries? Wow, it's the first time retail investors are actually talking about US Treasuries. And why not? You can get 4%, 5%. So absolutely. Leaving money in your high yield savings account of money center banks, which yield 0.02%, is complete disservice to yourself and your family, right? It's a financial hierarchy. So money market fund, or if you directly invest in Treasuries, is way, way much better than leaving money in the bank. It's another comment. Charles Schwab brokerage should be okay. Brokerage is with SIPC insurance, and they have a little higher insurance. Kramer hated NVIDIA 6 weeks ago. Don't even, NVIDIA, I'm still surprised how much run is left in NVIDIA. So that damn thing, I should call it damn thing because I own it in my portfolio, but I'm surprised. That's NVIDIA is already up. What? Let me just pull in 83% year to date. 83%. And it looks like it's still unstoppable. Right? I thought this is, 70% is too much too soon. But no, we continue to see these headlines around AI, and whenever something new around AI is coming, NVIDIA continues to stay strong. So this is its journey from almost $140, right, all the way to now $270, almost about 85%. So if you're holding NVIDIA in your portfolio, you're a happy shareholder. Yeah, Ra says, I want to smoke when NVIDIA smokes. I too, I don't know how long this hype of AI will continue to pump NVIDIA. So I'm a little cautious. Asif says best time to start network 2.0 and buy those properties in fire sale. Yeah, if you're a long-term real, if you have a long-term horizon and you love dealing with real estate properties, some of these properties will come out as a fire sale, right? When this whole commercial, when the fire will blow through these whole commercial properties. Yeah, Raj says another link. Asif, is it just conflict of interest end of a day? Why can't banks take a hit on profits, increase interest rate for depositors to Fed rate, but that will hit stock price? So CEOs don't want to do that because they get paid mostly in stocks. That is true. If increase, yes. So there are, and again, some of these CEOs, some of these banks haven't done a good job in terms of doing the work to earn the right way also, right? Many of the banks are today under trouble. The way banks make money is either you provide a good service and you can charge fee for that service, or you work out and go and provide loans to customers, right? So once bank have the deposits from their depositors, which is a liability for a bank, they'll have to, basically lend out that liability and convert it into assets by giving loans to the customers or consumers, right? And basically make that interest spread as income, or you charge a fee for the stuff. Many of these banks, instead of doing the legwork and hard work or loan, etc., also decided to just deposit in the treasury securities and earn some interest from there, some interest income. And now that has causing trouble to a lot of these banks. Not all. So in fact, there was I read somewhere on Twitter, and there was a screenshot from M&T Bank. That bank actually did a good job. And it was very clearly the CEO of the M&T Bank or the CFO, whoever's quote was in the report, they said very clearly, saying we are sitting and holding cash on our balance sheet, and we understand that it's gonna hit our bottom line in the short term, but we don't want to buy the treasuries at such a low rate when there are, when Fed is telling that they're going to increase the interest rates later, which is going to hit us in the long term. So for now, we do want to take a short-term hit just to protect us on a long-term basis. So this was M&T Bank. So some banks did a good job. They took a hit for short-term, but not all CEOs don't want to do it, because that will cause share price to go down, and most of the CEOs, almost all CEOs, get paid more in stocks than in cash. So Asif, yeah, there is a conflict of interest. CEOs get paid in stocks, and then they are focused on, they don't want to do anything that could cause stocks to go down. But it means after this crisis may also open up an opportunity for some companies to come and maybe offer a service that we will treat your cash as, put in a vault and don't lend out or buy anything from there. So only thing we're gonna charge is to keep and safeguard, or basically, they don't have to physically keep it, just that they could charge some fee and not lend out or the cash, or invest those cash in these securities, which is now causing trouble. Maybe we may see some bank coming up with that. So that will make, and if you're holding more than 250K, etc., you may want to take up that. You may be okay by taking up that additional a fee. We'll see. But I think this one is telling us that there is a need for to create a different service for depositors. Right. So yeah, so I think, and again, based on what we saw from FOMC, now the market expectation is that Fed will pivot in the sense probably they'll not raise rates and then they'll start to cut down the rates, and that's what drove the like kind of a Thursday, Fridays, little bit of a rally, whatever rally we saw. So now rate cuts are now being priced into the market. So we'll see if we don't get these rate cuts, is market gonna throw another those tantrums that it is famous for. All right, so I do see a few other people have joined in, so let's go back and little housekeeping is a couple of you pinged me on Meetup where you can see the recording. So you can see the recording of these sessions on the website. Once you register, it's free. You register it, go to members and say weekly webinars, and then you should be able to see all these previous recordings listed over here, right? Whichever you want to see, just click on it. You should be able to see the recording over there. So that's a little housekeeping announcement. Let's cover a couple of questions that were asked in the last session, in the previous one. One was, what can we do with our 401k, right? Again, this is not a financial advice. Each one's situation is different, but I'm gonna just talk about little on a more generic side. I expect some of you to share your experience, what you do with your 401k, maybe something different, something new that we all can learn. So here's I approach this, how I had approached my 401k. Number one, it depends on from what's, how far are you from your retirement age, first of all. And that will determine the mix of stock and the fixed income that you may want to hold in your portfolio of 401k, right? Do you have a need? Are you already in retirement? It means then you have a need to have a consistent income that you need your 401k to generate. In that case, you'll probably may have more fixed income or dividend paying stocks, anything that pay you regular income, right? When I say fixed income, could generally be bonds. Or if you have at least 20 years left for retirement, stock is still the way. You could still use the stocks because you don't need to withdraw anything from your 401k for the next 20 years. So figure out what mix works, right? Once you know what's the mix of stocks versus fixed income that you may want to hold, then you may want to look at, okay, which stocks I want to do. Now, if you don't want to do this calculation yourself, many of the 401k providers have something called target date retirement fund, right? So there will be, I think Fidelity, my previous employer used to have our 401k with Fidelity. We no longer have now, but they used to provide this target date retirement, target date, where is that? I'm just trying to, those were one. Let me just see, target dated retirement funds, 20, okay, like this, something like this, right? This is now Fidelity Freedom 2040 fund, means, and there will be like 2040, 2035, 2030, 2045, 2050. it means if I, based on my current age, if I'm gonna retire in 2040, or I plan to retire in 2040, then this could be another choice, right? In this case, I don't really have to go and look at the mix of stocks and the fixed income. Fidelity will do it for me. Right? Now, 2022 was the year in which both the stocks and the bonds were down. I mean, that was the worst year for that 60-40 bond performance. But if your need is to have a regular income, if you're already in retirement, then you really don't care what's the current market value of that bond is, because you're still gonna get that APY withdrawal, right? So right now, all these bonds which are underwater, when the bonds, those long-term bonds are underwater because of increase in interest rate. But if you are if you're only dependent on the interest income that is coming from you, then it doesn't matter. Right? So for those, if you don't want to figure out how much stocks or how much bonds I want to hold, or if you're new to the market, this target date retirement funds are not a bad choice. The only reason, I mean, I used to have these targeted retirement funds earlier, but what I didn't like was their expense ratio is high. Right? But it's a fee that you pay for Fidelity to do the legwork, to do all the work instead of you doing it. So that's one. But if you are active, okay, Asi says, does the target year, before that I see another one. Ra says, most 401ks don't offer MM. MM, I guess, is a money market funds. Yeah, I mean, 401k probably won't have this. Anthony says, use tax-free cash value from life insurance to supplement retirement, withdraw less 401k annually to low tax bracket, plus take out cash value from life insurance policy tax-free, will do more retirement funds and less tax. So I have a two opinion on this, because this is the topic that I think we talked about multiple times earlier also, is to use, these life insurance with investment objective or annuities, they do have a place, but for place in your retirement or in your investment portfolio, if you are completely hands off and don't, completely hands off, or just don't want to deal with the market, right? But over long term, this life insurance with this investment mixed in really doesn't beat a very plain vanilla index driven portfolio, right? Even including your taxation into account, right? There are, but it does provide a convenience. So I generally don't mix or take this life insurance with a supplemental retirement, because from a returns perspective, it's a pathetic instrument. But I'm sure it's better than putting your money in a high yield savings account, or someone who is completely hands off, just don't want to deal with anything. Yeah, it does have a place for that. But I would rather just use that money to put in, a passive ETF. Probably will do much better. But again, everyone's temperament is different. Everyone's needs are different. So yeah, it's something that you can explore. When I explored it, I said, okay, I don't want to do it, because there's a lot of money that I'm actually leaving on the table through that. So that's something which not for me, but for sure it could be for someone else. So you could explore that also. And then other thing to explore it, hey, if you want to use annuities, right? But be aware of the pros and cons of annuities. We have covered long back in terms of, again, I'm not a big fan because it's your money. You don't even get to keep that money if you're not there. There are better ways to manage that money, especially if you are spending every week, you are spending 2 hours here. Maybe you can do it yourself. But these instruments do have place in someone's portfolio. Okay. The other question asks, if does a target year means it will liquidate entirely with 2040 or start liquidating from 2040? So the way it works, and I also see that it works in 5 to 9K, is as you continue to approach your retirement age, let's say 2040, they will start to reduce the amount, the percent that is invested in stocks, and start to increase the percent that is invested in bonds. So let's say if you reach 2040, by the time 2040, probably most of your money will be in fixed instruments or bonds or yeah. And again, when I say most, it may not be 100%. Maybe you should read the prospectus to see. Maybe they'll reach out to 80-90% of your portfolio will be in the fixed instruments, and maybe only 5% will be kept in stocks, etc. So that's all. So it's not liquidating means not your portfolio, but yeah, they will start to convert or get less and less exposure on the stocks, but have more increase of exposure on your on the fixed instrument, because they know that you're going to retire in 2040. You have a need to get a regular return or income from that fund. So that's what even on 5 to 9K, it was in a similar way. One of my kid, I took an age-based 5 to 9K. So while it was, a few years left, it was growing. And then the growth in the 5 to 9K kind of stopped happening because, yeah, most of the money that was in 5 to 9K probably was held in more secure, low interest paying, but risk-free instruments, right? Which is okay, because, hey, my need is I don't want to invest the money which I need for a kid's college into stock, and because I don't know what's going to happen to the stock in next year, right? So this is how these targeted retirement funds work, which is a good way for anyone who don't want to deal with stocks and the bonds, right? You can just buy these targeted retirement funds. But those who are a little more active, and if you want to do your own stuff, again, I didn't pick any individual stocks in my retirement fund until I became active, right? So the better could be maybe go the ETF route, so that you're not, you don't end up into holding some individual stocks, because the individual stocks or companies can move a lot in both directions, right? Look at what happened to Square. It's down 15%. Right? So better would be to maybe stay in ETFs, right? Maybe a diversified ETFs. If you're looking at diversified ETF, SPY or any ETF, okay, if you're in a 401k, you may not have access to the direct ETF, but at least I had dealt with 3 different retirement providers. Each one of them will have something which is equivalent to SPY. So what you could go and ask them, if it is not clear from the nomenclature of the funds that are available, just go and ask your retirement service provider, which is the one which represent SPY. You may not, the ETF SPY will not be there, but they will have some funds which does the same thing, that is that invest into S&P 500 companies, right? So that could be another option. If we want to stay all US based, diversified, equivalent of SPY could be another option, right? Or like I said, or you could add your bonds with a stock and a bonds. Check on the fee again, but I mean, 401k, we don't have much options. Okay. But if you also want to diversify outside US, which again, in a disclosure, when I was building my 401k, I had a few of these. I had SPY, which is US based, and basically large cap. I also had IWM, which is a small cap, a small and medium segment. But then I also wanted exposure outside US, right? Last 10 years, US has done the best. I don't know what's going to happen in next 10 years, next 20 years. So there are some, but again, this is, I'm not sure. You'll have to, again, I'm giving the name of the ETFs here. You'll have to find out what is the equivalent fund that is available in your 401k provider. But right now I'm just sharing maybe a way to construct your portfolio is to diversify the risk at a country level, then diversify a risk at a sector level, diversify a risk at a company's level, right? So country level is you have a USA funds, then you go outside USA. Something could be an emerging markets, something equivalent of EEM, or there's an EFA. You have to find what's the equivalent of EFA, which is the rest of the developed markets except US, which will include Europe, Australia, not US, except North America. So it doesn't include Canada. So now these are a Vanguard, I think EAFE is a Vanguard ETF or something like that. So I did have some exposure to outside of US, a mix of both the developing countries, which is EEM, and developed countries, which is EAFE. Then precious metals, right? Precious metals do have, and again, the idea of building a portfolio is we want to have a mix of portfolio so that it's not 100% correlated, right? So some things which is little uncorrelated assets also, so that if one goes down, one goes down, the other one doesn't go down along with it. So try to have a different little either negative correlated or uncorrelated. So metals again provide some hedge, especially your precious metal, gold and silver. You can, in IRA, you can pick up GLDs, or if you're on a silver, there are many ETF, SIL, SLVs, etc. My go-to are GLD and SLV. Now, 401k, you may or may not have exposure to that. I don't know. You'll have to check in your 401k because in 401k, the choices are very limited. But again, when constructing the portfolio, we have a US large cap, some of a small medium cap, then outside of US as a hedge, precious metal, something in a bond. My go-to bond is TLT. If you like real estate, there are again real estate related ETFs, or if a tech focus, there are these sector specific. If you really love one sector and you know that sector and you understand that sector really well, there are many sector specific ETFs. If you have an IRA, you can buy all, pick up whichever sector you are comfortable with, right? But in 401k, you'll have to find out is there an equivalent of these, if it is available or not, right? So that's how actually, I had set up my 401k. Of course, when I became more active into individual companies and was able to spend time, I started and again, this is IRA, right? 401k, my 401k is all SPY right now. In IRA, I do have individual stock, which, yeah, I've said it, and I am comfortable holding it. I understand those, though I'm trying to reduce that and move mostly to these ETFs in my IRA. So from a retirement funds perspective, I just want to hold mostly the ETFs. But I did pick up some of the individual stocks during 2019. And of course, 2020 had a lot of time to go through these. And now I'm trying to unwind some of those positions in my IRA account, sell those and just buy some ETFs. Because on my regular taxable brokerage account, I do have a lot of individual stocks. So that's all. Again, anyone else have any other thoughts? How you manage your 401ks or IRAs? I want to make it simple, so I want to move mostly into ETFs and get the thrill of dealing with the individual stocks in my normal brokerage account. Then there are different things, which is should you have Roth or should you have a traditional IRA? Talk to your CPAs. There is pros and cons of both. You pay tax now or you pay tax later. That will decide. Again, you have to forecast what will be your income in retirement, how much tax you'll have to pay, or doesn't harm if you may want to have a combination of both. A little bit of a traditional IRA, then some of a Roth IRA. Yeah. So I don't know if you have any questions. I forgot who I had asked this around 401k, but I hope whoever had asked, talking about 401k, probably this is helpful. If not, if you have a question, do let me know. Put in a chat, or if you want to talk through it, that's fine too. And Tony mentioned about looking at some life insurance to supplement retirement. That also could be a choice if you want to go that route. I don't prefer myself personally, because I'm active and I think I can do better than those returns that you get from those life insurance investment products. Assuming it is highly unlikely that tax rates will come down in future, does it really make sense to defer taxes by using 401k? Again, as no one can predict future taxes. And one thing we know is increasing tax is always an unpopular measure. So politicians lawmakers will continue to kick the can down the road. Now, the problem here is we don't know where the road ends. Will the road end when I'm in retirement, or maybe my generation will be okay and the road will end in the next generation? So, and number two is not just the tax rate. Also, let's say even if the tax rate is higher, but your overall taxable income is less, you might end up paying lower tax, so that you could still defer. And again, this is the calculation. I don't know if there is a one answer to it. So what personally I have done is I have both a traditional one, and over the last, my previous employer was providing 401k Roth. So I used that opportunity for 2 years to put money in Roth. So I have a mix of both, because I don't know what will be the tax situation when I retire. So I'll deal with it when it comes. But right now I'm building a combination of both, a little bit of Roth as well as traditional 401k. Sam says 2033 end of Social Security. That will be mayhem. I don't know which government will will allow that to happen. I think we will continue to fund the social security, but on the other side, the inflation will show the dollar could get devalued. So the amount of the value of the dollar that you may get from social security will reduce, but the optics that the social security is still there will still, will still be there, because it's will be a very difficult decision for any government to not make social security whole. So, and again, we have got ourselves into in a big mess. And so far, this game has been working in terms of us, the rest of the world, funding our needs, rest of the world buying our debt. And we have been able to use that debt to print money out of thin air. I don't know how long will that continue to go, because we are seeing some portions of the world are already starting to de-dollarize. And if another 20, 30 years, dollars is not as strong, or the demand of our debt across the world won't be what it is today, then it will be difficult to fund all these expenses. Patient says index universal life insurance can be tax-free comparable to Roth IRA. That is true, but then it also depends on the return. I might save on tax, but I'll lose a lot more on what kind of returns come from investment in IRA versus what index universal life gave us. So that choice you have to make. Cool. So if you want a list of sector ETFs, nowadays there are ETFs for almost everything: gold, biotech, and these are the ones which are, low cost ETFs. You can find mutual funds. There are about 3,000 plus ETFs in the market, but these are some things which are pretty liquid, and I deal with it during doing options or even holding some of these ETFs in my portfolio. Right? So, for example, banking, I don't know which bank may go under. So I don't own any individual bank stocks. I only have XLF. Right? I think I have Excel healthcare. I'm not too good at healthcare sector, so I don't know individual companies, or rather I have Excel. I have a XLV. I'm holding XLV. So that's around 401k. So there is way for life insurance, or you can build your own IRA in combination of Roth plus traditional. Dave says nationwide fixed index annuity 10 years, 20% bonus first year. Year 2 to 10, 8% interest fixed. But it's annuity good for pension intention. So 8% fixed interest. So 8% fixed, I'm intrigued by this, because generally I've not seen in some of the annuities, I have seen the max cap to be just 6%, and that's the max, and there is no floor. But if it says 8% interest fixed, it is only for it looks for 2 to 10 years, 8 years. Yeah, something, maybe I'll explore that. And again, annuities also has a place. If you don't know deal with it, you want a regular pension, create your own pension, as someone just send you money, a check every month. Yeah, annuity is a way to go. Okay? But if you again, there are pros and cons of it. I don't want to go through that again. We have covered it in previous sessions. Raj, something to note with Roth 401k, the money it taxes a full AGA, which is likely at a higher tax bracket before the money goes into Roth 401k. That is correct. So yes, it will be your pre-tax full income. So you end up paying a higher tax right now. But then any growth, since it's a Roth 401k will be tax-free. The other thing which I have not yet explored is your backdoor Roth, because if you already have backdoor Roth IRA, right? Because the Roth has a limitation. Let's say if an employer doesn't provide a Roth, but you do want to invest in Roth, then there's something called backdoor Roth IRA, in which you invest in a traditional IRA, then you convert it into a Roth. But then there are some tax implications. If you already have another traditional IRA, then how it will work, I haven't been able to explore. Every year, I think maybe I should go and talk to someone to see what the overall implication would be if I want to convert some of my traditional into Roth, or I want to add this year to a Roth, but I have never been able to do it. If any one of you have done this backdoor, which in a situation where you already have a traditional IRA, and then you're also doing backdoor, if you can maybe help us out in terms of how the pro rata, etc. works, that'll be good. So Raj says he's been doing it for 10 plus years. Yeah, maybe Raj, if you can, maybe next, let me ask you, is this a interest of the topic which interests you in terms of backdoor IRA and Roth? Is this something that you can talk about in next session? Sure. Okay, so maybe we'll start our next week's. Raj, if you can come and share your experience of doing this Roth backdoor IRA, and especially around how does the tax implication work, how does the whole pro rata stuff work from a taxation perspective, that will help. Yeah, I think the basic step is easy, but and I've also spoken to some of my friends where people are not aware of or not able to take the step is, I have also have my traditional IRA in which I have so much money, how much it will get taxed, how does it get taxed, and all that stuff. So it'll be good to know from someone who's done it. Thanks, Raj. So next week we'll start with conversion, backdoor IRA conversion. Cool. All right. And I think there was also some question last week around how to store crypto assets. I forgot who was there. I hope the person is still there. Otherwise, I can skip this section. But who had asked it? Anyone want to come forward? Who had asked this question around how to store crypto assets? Should I cover or should I skip? Okay, Bobby. So thanks. So yeah, so there are ways. Okay. All right, Asif. Good to see you. See you next week. Of course, there are, for storage of your crypto assets, there are exchange wallets, which is nothing but when you sign up with your exchange, wherever they store it, or you can have your own software wallet on your computer. Number one, if anything, if the events of the last year had taught us anything, one is don't keep your wallet, don't keep your cryptos on the exchange. Move into your wallets, right? Now, where you could move in is either it could be a software wallet. There are more wallets available. Exodus, Jax, Electrum, you can Google it. But that means you are, or even Coinbase has a separate wallet, right? So, but that gives the control of those crypto assets to you. Mind you, these crypto assets with these exchanges are not FDIC insured. They are not SIPC insured. These are the unsecured deposits, so-called unsecured deposits at exchange. And if the exchange goes bankrupt, you're not going to get this back. And when Coinbase had mentioned this in their risk factor, when they specifically came and talked about risk factor, oh, everyone like, oh gosh, because no one knew that, I mean, we always think this is your stuff. No, you are giving it as a loan to these exchanges, and this is an unsecured loan. So now in 2022, I think everyone figured out. They learned by hard way that if you leave it on exchange, and let's say if the Coinbase or any of the exchange goes into bankruptcy, then you are in the end, right? Those are the unsecured loans to the exchange. So best is, if you don't need it for trading, move it off the exchange. You can move it to a software wallet, but if you're moving it to a software wallet, it is easy, but still your laptop could be prone to malware attack. The laptop could be prone to hacking. Phone could be prone to hacking. So you have to be careful from that perspective. So even the more secure is a hardware wallet, right, in which you basically move it even outside of your laptop, because your like any malware could start logging your keystrokes, right? There are things that these hackers do, and if you want to protect your crypto asset, the other thing is, even if hackers don't do it, if you have a software wallet in your laptop or on your phone, and if you, for whatever reason, you forgot to back up your phrase key and your laptop goes kaput, it's done, it's over. Then you won't be able to recover your crypto assets. And laptops or computers are prone to crash, right? So the other option is you move it to your hardware wallet, and nowadays there are a few more. Many new type of hardware wallets are there. The two most famous are one, the Ledgers, Nano S, Nano X, and then also there are Treasure. And these are the ones which comes in the shape of a USB dongles. So maybe I can, okay, there are a few more, like these are the Ledger ones, Treasures. Now there are a few more that are started in the markets. Now, what the benefit of this is that for any if there is any transaction in which you need to transfer a crypto, you need to plug in these USB drives or these wallets into your laptop, right? So unless someone is in physical possession of this, they can hack you. I mean, someone needs to be in a physical possession of these wallets, right? Compare that against your software wallet, which is a wallet which is on your computer, right? If someone has gotten a backdoor access to your computer, or some hacker has taken over your computer, then they could actually move your take over your assets. But in this case, it has to be physically plugged into your machine. So a little more secure, but then you have to, like Bob said, yeah, you're trusting the hardware software wallet vendors in that case. That is correct. So go with the reputed ones and not the new ones. So I think Treasure and the Ledger have been around for years. So I would rather go with them than any new ones. The final ones is a paper wallet. It used to be a thing before these hardware wallets became more popular. But if you want, in paper wallet, you basically create your own, you imagine a very strong password, or you use a password generator to create your own strong password. This is more for more geeky people. And then you could go to, let's say, myetherwallet.com. But this, I mean, I've done it for Ethereum. You create a very strong password, key that in, it will give you a passphrase, it will give you a private key, which you can print in your paper, right? So again, then only you have access to that private key. But I think, again, there were some concerns around the, Bobby, like you mentioned, what software vendor were using. There were some concerns around my Ether wallet. I think that got revealed 2 years ago or a year ago. That so again, that's their concern. So far I haven't heard any concerns around usage of Ledger or Treasure that anyone have been able to break into those. But these are the things. So I think from leave it on exchange if you're trading, or maybe leave only a small amount which you need for your trading, move the rest preferably to a hardware wallet. And I guess those are the ways. Rajiv asks, how about third-party crypto custodians? So there are crypto custodians, but not for, individual owners. There are, so for example, I think Coinbase, if you really have a large amount, then you may be able to make use of, let's say, Coinbase custody solutions. I don't know, do they provide to the individual ones? I don't know. But in that case, I'm still depending on Coinbase to hold my digital assets. Okay? And if, let's say, Coinbase goes bankrupt, I don't know now in the bankruptcy queue, where do I fall in? So the problem of depending on third-party crypto custodians is our laws. This is all right. Still, this is a wild west. We don't have those regulatory protections that you would have, let's say, in terms if you are custodying your cash to the bank, or you're custodying your stocks to your brokerage. Okay. So that's the risk which you run into if you're using third-party crypto custodians. What protections do you have if that third party goes under, right? So that's your counterparty risk. And at this point of a time, I am not very comfortable in taking that risk. You know, even if you look at the ones, this whole Celsius, is it Celsius or not? Yes, I think, or BlockFi, one of them. So even now, it's been almost a year. The ones that were using their wallet, not the ones where they were actually getting a return, but the ones where they were using Celsius wallet and their custody service, they haven't got their assets back yet. So the laws around who comes first in case of bankruptcy are, if you have given, do your custodied assets are protected? There is probably no. So that's the risk going with the third party, because the protections are not there. Okay, Dave, thanks for the link, Dave. Yeah, I will look into this one. 8% sounds good, but yeah, so I'll study on it. So I'm right now, given so many third parties are just going under, I mean, the whole Celsius, BlockFi, Voyager, all the issues that we are seeing is because we had a trust from those parties, and now those parties have gone under. So everyone is now suffering through that counterparty risk. And if you really look at it right now, today environment is very hostile to any kind of a crypto, a business or crypto company. This week, we saw Coinbase getting Wells notice from SEC, which is really a big deal. The Coinbase is a publicly listed company. It's a publicly listed exchange regulated under US laws. And this week they got Wells notice. So Wells notice is the notice that SEC will send to the companies whom they'll send it to the companies for whom the SEC has completed the investigation and have found reasonable cause to pursue an enforcement action against the company, right? So it's kind of an early intimation saying, hey, we're gonna come and sue you guys. So this week, Coinbase got the Wells notice, which kind of surprised. I would say surprised, but it was. I mean, right now this is blowing up on the whole Twitter. Is Coinbase have been very open about their operations. They have mentioned everything because they went public, so there were a lot of disclosures around how they do business and what services do they offer, and they've been kind of talking to SEC officials for months, but SEC have never came back to them and told them anything, and now they received the Wells notice. So this is clearly, I think, as we, on one hand, we see contagion on bank, which kind of tell the rest of the world that U.S. banking system, U.S. monetary system is now a little bit shaken up. So in parallel, we are seeing all the, I would say, coordinated effort by various government agencies to go after all crypto-related initiatives, right? So, which is, hey, it means we don't want any other system to come up which could challenge your system. So I'm not sure that I mean, it could be just pure coincidence, or maybe this is a way to keep others from buying into any other system which is outside or not controlled by, let's say, US government. But we also saw Custodia Bank. Again, this is a bank which has been denied account with Fed because this bank also provides services to crypto companies. Now, one of the reason that was given, and this is hilarious, is the absence of deposit insurance coverage at Custodia could increase the firm risk of runs and contagion, right? Because this won't be covered by FDIC, right? So a Fed told that, oh, because you don't have a deposit insurance, we can't allow you to have a master account with Federal Reserve, right? All other banks have, because there could be a contagion of risk of your bank run. Now, what happened with Silicon Valley Bank, or what is happening with other First Republic banks or all other regional banks, right? Despite the fact that Custodia will have 108% of the deposits will be deposited with Fed. So, for example, if as a depositor, as a bank account holder, as a crypto company, if I've deposited $1,000 in Custodia, Custodia will deposit $1,080 in a Federal Reserve account. Right? This is completely opposite of what these traditional banks do, in which you have a fractional reserve banking, that if you have received $1,000 from a depositor, with the Federal Reserve, we will only keep $100. So, and that's the reason why these banks, the traditional banks, need FDIC insurance, because they operate on a fractional reserve banking. If you have a bank run, you don't have enough money kept aside to service all those, who want to have a fractional this reserve banking, because there's a bank run. Custodia doesn't even want to do that. So there is no need for a fractional reserve banking. So there is no need for insurance, right? And How would they do it? I mean, how would they survive? Because they say we will survive on making, by providing a service for which we can charge fee from our customers. But they were denied. I mean, it's like, why do you need insurance if I have over collateralized? I have given you, you gave me $1,000 and I bought $1,100 worth of treasury and I've kept that. Then I don't need any insurance because I already got $1,100 worth of treasury. So, but they were denied. And one reason, again, because federal is not a government entity, right? If you know the history of Federal Reserve, it is actually owned by a private banks. So these the private banks have a stake in these Federal Reserves, in our Federal Reserve. It's a private institution. So they won't let anyone to to turn the whole fractional reserve banking upside down. And finally, on Thursday, I noticed another one, which is SEC came up with a bulletin for investor alert, which talks about exercise caution with crypto assets. If you are dealing in crypto assets, why you should be very careful, which I would agree, because this is not protected. You only put in what you can afford to lose. But I mean, overall, we are seeing the US market is becoming very, very hostile to overall crypto industry, right? So if you still want to be active on this one or want to enter in, just under the US is right now, it's not looking good. The other countries, I think Europe and UK, they are trying to put in some more sensible regulations, but US is being completely, looks like they just want to shut it down. Fed's main agenda asset inflation counter mass opinion. Where would Custodia come up with the extra 8% for all deposits? So that's what they mentioned is they will generate it through the additional fee for their services. And I really don't care where they come up with, as long as they are able to have those deposits with the Fed, in the Fed Reserve account, which is generally will be the treasuries or the bonds which are issued by government. Raj, end of Fed. Also, FDIC has 1.25% all deposits, more funny money to be printed. Oh, absolutely. I think the number is close to whatever 1.3 or something. The maximum by the FDIC charter or something, maximum would be 2%. So right now they are 1.25, 1.3%. So if there is indeed a bank run, FDIC doesn't even have money to make everyone whole. So only thing we're gonna do is just print money. Jay, they can't instantly generate 8% in fee on millions of deposits. Seem like a dumb business model. Yeah, I haven't looked at in terms of what Custodia is planning to do. In terms of how will they be able to have this 8%. I don't know if they're putting their own assets over there. But my only point was, even with an over collateralized deposits, Fed is still said, no, we don't want to, we are denying you master account with us because there could be a, you don't have insurance coverage. I mean, you don't need it. Now, how they get to 108%, which is different, I don't know. Yeah, self-insured, don't need FDIC insured. That is correct. But no, this is the current state. So of crypto, very, very hostile, especially after Coinbase got the Wells notice. In fact, I saw some founders of outside of the US on Twitter expressing such a surprise. I mean, some of the exchange founders because everyone holds Coinbase on pedestal in such a high light, saying, hey, you guys have been very highly regulated. You've been, in the forefront when it comes to do the right thing. So very surprised that SEC is going to pursue enforcement action with them. So I would not put money in custodial style account with crypto risk. I prefer FDS. Yeah, so custody is to serve, I think, crypto companies. It's not a bank account. I don't think this was for individuals, but let's say these crypto companies who need a banking services, custodian wanted to do that. Yeah. All right, what else? Let's continue our discussion. Okay, this week I picked up some XLI, XLE, XLV, healthcare, little energy, industrial. This was to, I got some last week, SC had a call assignment, so put that to use. Overall, still not going, huge into the market just yet. Treasuries, that ladder continues. I added one more ladder this week for my T-bill ladder. I think that got executed at, I think this one was for 26 weeks. So mostly are 17 weeks, but this time I did one for 26 weeks. I think around 4.8% APY. So since we were talking about insurance, another thing I want to share is which are the different agencies that insure your funds, right? Banks, FDIC, credit union, NCUA, safe deposit box. Actually, no one insures this, which I don't think many people know it. So if you are using safe deposit box, inherently, we assume that's the safest thing, right? Hey, I don't want to keep these things in my home. You have some expensive watches, you have some jewelry or whatever. You don't want to keep it at home. I want to go and put it in a safe deposit box. It's with the bank, it is covered. But when it comes to so-called insurance, it is not insured. So if none of the regulatory or government agencies insure it, bank may have purchased insurance or may not have. So if, let's say, the safe deposit box is robbed, then there is nothing, no government agency will come, no FDIC will come and make you whole. Brokerage account, SIPC, 401k is insured by Department of Labor, and insurance is from our state guarantee funds. Raj shared a Lynn Alden. Yeah, I love reading about Lynn Alden, especially her long articles. They are so insightful. Custodial bank wanted hold Fed, 108% deposit with Fed. They were like, nah, can't have that. This scared the hell out of big banks. True. JP Morgan sold contents, their error. Couple claims JP Morgan sold 10 million of their jewelry after drilling open a security box because they didn't pay their rent. Ooh. Not pay rent bills. Oh, pay to wrong address. Yeah, so that's not insured. A safe deposit, contents of safe deposit box are not insured. Oh, when it comes to JP Morgan, let me just go to another one. Oh, this is a little hilarious. So JP Morgan, so again, on a London Metal Exchange, and that's the world's most trusted exchange for trading into metals and commodities. So JP Morgan had sold some nickel contracts. Means, and these commodities, now the difference, these commodities, are the, like, if you sold some future commodity, futures on a commodity, and then, if whoever has bought that, then you have to deliver. If it is not closed before the expiration, then you have to deliver that stuff to you, right? So if you bought oil futures, and if you're at the expiration date of the future, if you don't close it, you might see some oil tankers outside your house, right? So because those are delivered, and that's what had happened in 2020 when no one wanted to take a delivery of those oil because COVID was there, everything was shut down. That's where the futures actually went negative. And that was the first time probably I've seen in my life something trading on the exchange at a negative value. So JPMC had sold some nickel futures, and then they had to deliver those, and those nickel futures were the commodity nickel that is backing up those future contracts were held in a warehouse in Rotterdam, right? And it's only when the metal traders try to figure out, they had bought those nickel contracts, futures contracts, when they were to get the delivery, what they found, they actually got a bag of stone instead of a nickel. So JP Morgan was the owner of these bag of stones at the warehouse. They were supposed to have nickel, but instead of that, they were actually holding stones. Not a big amount, but the fact that this has happened on contracts trading on LME, that's why it became a big news, because the contracts on LME are viewed as beyond question, right? It means you've done all the verification, everything is uptight. But in this case, whoever was the order, eventually they ended up having stones and not the nickel. So whoever wanted to hedge their nickel exposure, etc., didn't work out for them, which was a little, fun day. And the way founders a warehouse worker stubbed his toe against the nickel and was like, that's not a sound that nickel makes when you kick it. So when you open the bags, and then they found the rocks in it, and then they reported to LME saying, London Metal Exchange, saying, hey, this particular location in this warehouse, which is so-called termed as a nickel, it actually doesn't have any nickel. It's same thing like before we went off the gold standard, we all assume that Fed is holding gold in the Fort Knox, but who knows what is over there, right? And this is what happened with JPMC. Fed Reserve Board reduced reserve requirement ratio to 0%. Yep, and so technically, and I think we talked about earlier, technically, banks can lend out infinite amount of money, because in a COVID, the reserve requirement, Raj, was brought down to 0. The only reason banks don't do it is they may never get that money back. So, but yeah, this whole fractional reserve banking is now, we realize that it's crazy stuff. Cool. What is this? Okay, hold on. Other stuff we saw, what was happening is Silicon Valley Bank, once they figured out, and again, now these things are coming out, right? These these cockroaches and the skeletons from the closet are now showing up. Just when the regulators start beginning, to detect the flaws in its risk management. And again, I got to know that they didn't have a chief risk officer. Probably that chief risk officer left company because they figured out there's too much of, they were not really managing the risk the way it should be. And again, we talked earlier that the way banks make money is to give out loans, but you have to really go and do the work to give out loans. So Silicon Valley Bank, most of the customers are startup companies. They may not need that much of a loan. So what they did was to give credit to loans to a lot of insiders, just to show up that we got more assets in loans on their books. So loans to officers, directors, principal shareholders, and related interests more than tripled from a third quarter last year to in the final 3 months of 2022. This is the record dollar amount of loan issued to insiders going back to last 2 decades. So these all are regulated banks, and I don't know. And here we're trying to kill the more transparent ecosystem. But this is the new stuff now coming out, that they realized that their books are upside down. They have a lot more deposits, which are the liabilities. They're not making loans. So what to do? Let's give our loans to our insiders. Huge amount of loans to insiders so that it looks good on the books that now we have assets worth $219 million. Crazy stuff. Something different. We saw Hindenburg research report, and Hindenburg, but a few weeks ago, they had a research report, short report on Adani Group. Now, after that, the big one that they are now targeting is Block. Block is what was formerly known as Square, and it's a full list of allegations on why is around Square, and a lot of concerns that they have raised. Any Square shareholders? Okay, Jay says funny famous video, but more like random crypto, and it's gone. How many people do we know that actually lost money in FDIC accounts? Raj, exactly. FD account and give me anything deposited in a bank at a large scale. Yeah, so let's say even on this Silicon Valley Bank, it's a, how should I put it? I think no one in a traditional banking system now will directly lose the money, but we will lose the purchasing power of what we are holding through the money printing, which will require to be done to give you that money. So you deposit $100, you'll still get back $100, but you will only be able to buy whatever $50 worth of it, if I can put it that way. So directly, because Fed can print money, right? So Fed can print money whenever they want to, and so from the fact that if I put in $100, will I get back $100? So far, Janet Yellen is saying, yeah, we'll make you whole. But we know the only way they're going to make us whole is to print more, which is going to bite us from our, not directly in the front, but it's going to bite us in the back. So anyway, so the more I start going deeper into this, the more I realize, what the crap? This will work. as long as the US stays as a reserve currency. But this whole behavior of running such a huge deficits and those money printing have taken down empires every 150 to 200 years. So, but we are not, I think that's a bigger problem I have, is now if you're gonna insure all depositors in all accounts, irrespective of deposit amount, then what's the point of giving 250K FDIC insurance? Right. This is a moral hazard to it. All right. Raj says, you mean Square bag holders? I'm one of them. I hold Square in my portfolio, and this is where keeping a position size helps. So a few summary which I looked in as CNBC. This is what I want to go through, and then I also found some rebuttal to this. So want to put in both sides. You can choose whichever and make your decision in terms of who's right, who's wrong. So what Hindenburg claims is Block allowed criminal activity to operate with lax controls and highly inflates Cash App transaction user base, a key metric of performance. So if you remember our earnings review from Block, so Block has two businesses. One is the Square, which is what the company started with. Then they added another one called Cash App. So Square is for small merchants, small businesses, farmers market, or you go to restaurants, or you go to any individuals, who are selling it. They'll have a small Square dongle in which you can plug in your cell phone, and then you can swipe your card, right, to take payments. That's how they started. Then they added another product called Cash App, which is for end consumers. You can have your bank account open a bank account through Cash App. You can deposit your money in Cash App. You can buy stocks through Cash App. You can get loan through Cash App. You can buy crypto through Cash App. So most of these allegations are around the whole Cash App stuff on the consumer side. They say they have a Wild West approach to compliance, which I'm surprised because, hey, it is. The results are publicly audited. It's a public company. Risk and compliance is generally, when you're dealing with financials, that has to be on the top. But let's continue. They say those unbanned customers were involved in criminal or illicit activity. As a part of 2-year investigation, this is what I like about Hindenburg. And I think now in the town of short sellers, probably Hindenburg is the only one remaining game in the town. I don't see any more short sellers from Carson Black, Muddy Water Research, or are these the two things? There are 3 short sellers that I knew about. They used to generate reports. One was Hindenburg, another one was Muddy Waters, and the third one was. And I know one of them decided that he'll no longer be short seller. So that I understand, because that short seller are personally targeted. His family was threatened by those on Reddit. So he says, not really worth putting my family in, endangering family. But nowadays I only see a short seller report coming from Hindenburg, and they did a good job. 2-year investigation, spoke to multiple former employees. And I think their main concern is lacks of internal controls, not doing proper KYC, and not having a full compliance in place. Up to 35% of Cash App revenue is derived from interchange fee, and that's around 892 million. And they say it should be capped by law. And now the reason they are able to derive such interchange fee is because they work with smaller bank. The larger bank have a limit, but the smaller banks don't. But I don't know why that is bad. So anyway, so they also looked at took a issue with cash app practices during COVID pandemic when the government issued stimulus checks to qualified, well, we all know government is helicopter money. The report alleges that the lockdown posed existential threat to block critical merchant services. True. This is the square side of the house. So Jack Dorsey tweeted the users could use government payments through Cash App immediately with no bank account needed due to its frictionless technology. So I think when the government checks were issued, and I do recall this announcement did come from Square or Block saying you can use your government checks and you'll get immediately basically account in your Cash App account will be credited with that. So what Hindenburg has told that there were a lot of suspected fraudulent payments that had happened, right? And now many of the states are clawing back on that. Yeah. Oh yeah, the Brass says third one was a Citron research. Yeah. I think Citron is now decided not to do any more short selling. To do short selling. Now Citron has become long investor, not a short seller. So that's so most of their claims are around disregarding AML, KYC, fraud happening on Cash App, and all that stuff. So when the report came out, shares were down 15%. Not a surprise. Hindenburg is a well-respected short seller. And then Block provided this response to the, in response to this short seller report, this is what they did. They said, we intend to work with SEC and explore legal action against Hindenburg Research for the factually inaccurate and misleading report that they shared about our Cash App business today. It's not, doesn't mean that they're gonna do it. Doesn't mean anything for now, right? It is that we, first of all, we intend to work, not that we are working with, or we will surely work, and explore legal action. We're gonna explore. Maybe decide not to do or anything, right? So this is more of just a PR that someone has to say anything, which is good. They're not committing anything at this point of time. But what I found interesting was someone else fought back, which is because ARK or Cathy Wood Ark, they actually bought more Square shares after this report came out and when the Square fell down. And so I do want to read what ARK has to say. Again, I'm putting both sides. Now you can decide who's right or who's wrong. Or maybe Hindenburg already made their money. The stock was down 15%. So let's see what ARK has to say. What Hindenburgs tell you, Cash App was the only electronic P2P payment processor mentioned in COVID fraud indictment. This is what Hindenburg says that, hey, you are indicted by SEC. What they don't tell you, which they cut out from the screenshot, is that the defrauded funds came via Bank of America, which sent criminal more than $1 million in those benefits. So part of the indictment document that Hindenburg doesn't mention is these, which is Bank of America. What they do show is this, which says that the Cash App, $85,000 were accessed through Cash App, which is what government is coming up with its indictment, right? Which is true. It doesn't absolve Cash App from their responsibility that $85,000 were accessed, which should have been, right? But I think what they say is this is not the problem which is particular to Cash App. The vast majority was obtained through BOFA and was cashed out using ATMs, 375,000, bank branches, 39,000, BOFA debit cards, 205,000. All the money transfer services were defrauded and not just Cash App, right? Money transfer, fund transfer services, including Cash App, were responsible only for 7%, right? So their whole idea was, Hindenburg is saying, as if the Cash App was the only one whom the government has gone behind. This fraud happened at a much larger scale, much massive scale, and Cash App also got caught under the same. So would you say even Bank of America has a lax KYC controls, has don't pay any attention to AMLs, etc.? It is, if you're saying Cash App is that because they didn't take care, or they are indicted by federal agencies for what happened during COVID, then we should put every other bank or the other people in that indictment onto the same pedestal. In other words, 88% of the money that the criminal was able to obtain was cashed out through traditional banking system, not Cash App or not any fintech company. And then there is another 500K delta, which we don't know where it went. So while Cash App likely was used for fraud, a problem that every financial services company is battling at the time. Ironically, in this example, Cash App spending limits might have prevented the criminal to cash out even more funds. Okay, so looks like there is a spending limit on Cash App. So what Maximilian is saying is that feature actually prevented them from creating even a bigger fraud. Right. So why use this example? All financial services, including banks, encounter combat fraud, especially during COVID pandemic. Square and Cash App are no exception, although the short report makes it sound like that this was happening only with the Square and the Cash App. So there is a link to another article. Oh, Green Dot, PayPal helped seekers recover more than $400 million. So even criminals have swindled $100 billion. Wow. So, and here we are talking about $85,000. So what else? Fraud is an optimization problem. Companies have a risk engine that they're continuously perfecting, and can tune up or down. Some fintech companies might have temporarily tuned them down to provide a lifeline to many struggling individuals and business ignored by banks during COVID. Okay. Next is this report is made up of half-truth and misleading data points, or ones the investor community already knew, but could be follow-on implications of bank, block, and fintech as a whole. Okay. So all they're looking at is that this report could invite more regulatory scrutiny on the overall fintech. Okay, then they talk about Fed now and all that stuff. So essentially, I think at least what ARKK is saying is that agreed, there was a fraud done, but this is blown out of proportion by the Hindenburg research report. So I think, so there's probably from their perspective, it may not be as a big deal as what the research report is sounding it out to be. And we saw ARKK again, they bought a bunch of Square. So you decide which side you want to be, but because of the short report, the volatility, the implied volatility just suddenly shot up. So you could see some huge juicy premiums in Square. So if you look at a Square and look at his IV from it's now up to what, 42%. So we saw a huge jump in IV from after this drop. So if you look at let's look at what next one is 21st April. So almost close to 8%. So you have close to 8%. The short put is now close to 8% for next 27 days. So IV is high. So there is a juicy premium in it. Now, depending on which side you are, you can decide what you want to do with this premium. But these spike in the premiums sometimes does open up an opportunity to do some option trade. So I did a put spread on Square, but we'll see how that goes. So that's why I did a spread, because the premiums were really juicy. And from my perspective, when I was looking at it, I thought, if the report is only for this, maybe it's too much. And I took a chance on it. It's a spread, so risk is defined. So I'm not too much bothered about it. We'll see how it goes. Okay. It says they didn't short Buffett because Buffett is behind it. Oh, that is true. No one wants to go against Uncle Buffett. Okay. All right. What else? TikTok. The CEO of TikTok was pulled into Congress, but it didn't really go well. I only was watching live for 30 minutes, and this was bipartisan grilling of TikTok CEO, and the topic was the same. Like, you are an agency of Chinese government, the data leakage, what kind of a data you're collecting, what kind of access does the Chinese government has it, or your employees in China have it, how are you going to safeguard and all that. The overall summary is, it looks like it didn't really go well for a TikTok. I actually was, during the initial point, I think when that question was asked, what the first question was, can you categorically say that, so the question was, did anyone from CCP helped you to prepare for this hearing? And the CEO couldn't categorically say no. He could have answered this in one word, no, but instead he gave a little long-winded answer, which seems to say, okay, if the start was like that, you could have imagined how the rest of the hearing could have gone. So what I was seeing in Twitter and other places is that this really didn't go well for TikTok. Now, Congress is demanding two things. There are two options. Either you ban TikTok, which is what I would love. But the other option is they'll have to divest. Basically, ByteDance will have to divest TikTok and hand it over to an American company, and not to be owned by ByteDance anymore. But Chinese Communist Party has told that any divestment they will not allow. So we'll have to see what will finally happen. But from an investment perspective, this was a good news. This will be a good news for Snap and Facebook if TikTok gets banned. So we saw some uptick in Snap shares after this hearing. I think Snap was up some 8%. Once it was clear that this hearing is not going good, and eventually, I think I also saw is a comment from this is one FCC commissioner. The most important thing Mr. Chu had to do was to build some level of trust and credibility, and he completely failed to do that. So as a Snap and a Meta shareholder, I was happy. And I don't use TikTok anyway, so I have nothing to lose here. All right, P. Shang said, put spread as in a bull put. Yes, it was a bullish trade. Again, I just wanted to take advantage of volatility of the immediate spike in the vol that I saw, and that's why I did that. Raj says every CEO should be asked that question. They all have consult to help deflect question. I'm sure, he would have been prepared by many lawyers, but again, and while I was listening to this, while preparing breakfast, I was listening to it. So at that time, many of the questions were like, yeah, I'll get back to, I'm not really sure, kind of stuff. So he was not really answering all the questions. But I mean, it was a cruel grilling as well. But it was good to see lawmakers from both aisle at least united in this case, whether to ban TikTok or not. Oh, by the way, France banned TikTok. Was it today? Yesterday. So I don't know, why are we not banning TikTok? One reason is a lot of VC money is in this. So unless they take out their money, I think probably we won't ban it. Okay, so France bans for government staff phones. Okay. And now even Netflix? Oh, for civils. Okay, for government staffs. And TikTok has a better product compared to other platforms, but TikTok is also, it's like a spy device you are carrying and holding it. I don't, I mean, again, it's a capitalist society. You can, if someone wants poison, we should be able to provide poison. If you subscribe to that theory, yeah, let's keep TikTok. The irony is that Western intelligence is embedded in Meta, Google, US social media. That's why China doesn't allow Meta or Google to operate in China, right? Why are we allowing TikTok to operate here? I mean, same thing. So why? So Google is not allowed in China. Twitter is not allowed in China. And so why are we allowing TikTok here? Google, oh, why are we? Samsung, my modest smartphone is a state company, Lenovo. Every social media company minds the data. I think the issue is not that the social media company has access to the data. The issue that we are taking with TikTok is that Chinese government has access to the data. It's okay. I mean, US government also does the same thing. US government spy on their own users as well. But we don't want Chinese government to spy on us. So that's a concern that they are raising. Because TikTok is nothing but an agency through Chinese government, and this is a known fact that every big company in China has a representative from CCP on their board. I forgot, it's called what, golden vote or something. And even ByteDance, and this was a question that was asked, even ByteDance has a representative from CCP and on the board. So when the question was asked of him about that, all he was saying, well, ByteDance is a separate company, TikTok is a separate company. I can't comment on their political affiliations. So, but anyway, yeah, India had banned TikTok, but we'll see. I guess, again, my theory is maybe there's a lot of VC money that had gone into this, and maybe let the VCs come out by doing the secondary offering and whatnot. And after that, then, they can tell their lobbyists saying, okay, we have taken our money out. now you can go and tell lawmakers to ban it. Why are we waiting for such a long time? India banned it what, a year or 2 years ago? All Chinese companies CCP access to president office, cap rep next door to man. Yeah, exactly. That's what I was talking about, Savage. Is they have a golden vote in every company. All right, guys, it's 11 minutes past 2 hours. So I think let's stop right here. And so for next week, we'll also have Raj talking about backdoor IRA. And I'm also thinking maybe, I'll invite some other speakers. One idea which I have is maybe reach out to the, some folks who are expert in some fields and can give us a breakdown of a particular business, right? Maybe someone from a semiconductor field, if you're a product manager or engineer semiconductor field, come and talk about how that whole stuff works. Someone working on a payments industry can talk about how the payment industry works, what's an interchange fee, how does this relationship between banks and the networks look, how does the whole stuff work? Maybe I'm just thinking about this, and let me know, if that would be useful. I can start to invite at least some of the people that I know who are so-called has spent years in a particular industry, right? I won't be able to do a good job of analyzing that industry as such. I would rather have someone else who has spent years or who work in that industry come and talk about the details of that industry, right? Some real practitioners. So I have it on my mind. We'll figure out when we can, do that. So, so if there is a topic that you feel very close with and think that you can share that with the rest of the folks, feel free. Let me know, and stage will be yours. All right, guys. Thank you, everyone. And we'll talk again next week. Okay. Hopefully, markets will continue to do what they've done, back and forth. So until we get some good direction from Fed. So we'll see. All right. Bye-bye, everyone.